Welcome
Okay.
everybody to Billionaire Acquisition Mastermind, number one M&A group in the world. And as you know, we're looking to bring in experts to provide insights and clarity in regards to various topics. And today we're going to talk about deal funding and deal structuring. So here we have Pete, whose experience and background is in investment banking, and Brian Harder, whose experience is regarding banking and funding. If you guys could introduce yourself very briefly.
Sure. Thank you, Valentino. This is
Yeah.
Pete Previtt. I am the general manager of Farris Group. We're located in Florida. We are a managed services company that essentially focuses on helping companies grow, and I'm responsible for M&A, sell side, buy side, and so forth. And thrilled to be here. Thanks.
Thanks, Valentino. So my name is Brian Hartman. I am the president and founder of Ferris Funding Partners, and we are a commercial mortgage brokerage company handling everything from SBA loans all the way up to hard money loans, depending on the scenario that you're looking for. We work with about 150 lenders all across the country, so we're able to handle everything nationally. And we like to say when the bank says no, Ferris Funding is the way to go.
I like that. Brian, if you could get a little closer to a mic, you're a little muffled. But let's get started here with the questions. As you know, guys, same structure. We'll start with our questions, and then we can open it up for a Q&A. Ansi, if you could, just reach out to guys on Facebook. So, in regards
Sure.
to the lending, majority of our members are in the buy side of M&A. So I want to ask some questions that pertains to them, right? So one question is, do you see any industries or sectors that you would say to stay away from at the moment?
Ethan, do you want to take that one?
To stay away from at the moment, not necessarily. I mean, everything that we're seeing, there's a lot of capital out there. Any business that is profitable and growing and has good growth prospects, I think is good to look at. I don't know. Maybe commercial real estate right now. So one of the concerns that we have is with COVID, a lot of companies have scaled back their in-person work staff. A lot of people are working remotely, so there may be some investments, related to commercial real estate that might be a little bit iffy going forward. But I right now, because there's so much capital out there, any business that's showing growth and that has good profitability, I think can attract investor dollars.
Great. On the other end of the spectrum, do you see any industries or sectors that are really hot that you say a lot of money is going into?
Manufacturing is huge. On the buy side, we work with lots of PE firms and strategics that are looking at manufacturing. Automotive, any automotive innovations, certainly with electric, that's big. But I would say the biggest one is manufacturing. We have so many companies that are looking for that, and I think what you're going to see is with everything that's happening with China, there's a trend to bring manufacturing back here in the United States. So either look to manufacture critical items here or bring back manufacturing from overseas into this country, specifically from China, with some of the issues that we had there. So, anytime you can find something that can be made here in the United States and create jobs, there's a lot of incentives available, workforce development grants. There's states are really pushing to create new jobs, and manufacturing sector across the board in all kinds of industries, I think, is one to look at.
That's great to hear. Now, in regards to emerging industries, I want to talk a little about that. As there's many advancements with technologies and a lot of new things popping up here and there, do you think that banks are more on the safe side as there's not much data to go about? Essentially, due to growth being speculative or being based on hype.
Go ahead, Brian. You want to address that one?
Yeah, I think the banks are they definitely became more conservative when the COVID broke out last year. Um, that typically happens almost any time that there's either a recession or something, some type of pandemic like we had. They become automatically more conservative. They're and then as time passes, in order for loans to start to open up again, there's got to be really good explanations to what took place. Why was there a dip in the revenue cycle for the business? And then what are they doing to be able to advance that to get back to where they were prior to the recession or pandemic taking place? And then as time passes, further, I think we'll tend to get away from that. But right now, it's going to be most important to be able to give a really good, detailed explanation of why the dip, and then what are they doing to be able to recover from that. And it'll give banks a lot more of a comfort level to be able to lend money again. The other thing to think about too is there are alternative lenders outside of the banking industry that are not as risk adverse. So a lot of them step up to the plate to kind of take the place, if you would, of what the banks are not doing.
Great to hear. Now, one of the major reasons a lot of people go the bank route instead of private equity is because, as you know, it does not dilute holding equity of the owner. So that is major from. Now, let's talk about what are major things that banks look for, or any lending institution per se look for in regards to funding a deal. Cash flow. I know cash flow is very strong from what I've heard. They want to look at the past 3 years. So excluding 2020, talking about, let's say 2017 to 2019, how was the volatility in regards to the revenue, in regards to the earnings, if it was stable or many ups and downs. Then during COVID, they want to look at, how the COVID affected the business, for how long, what effects were they able to bounce back, and how are they, positioned to grow amidst COVID, correct?
That's absolutely right. So they're going to look at what was the trend up to the point of the pandemic, what happened during the pandemic, and then what are they doing since then to be able to recover from that. So if you can start to see the trend going back up, then obviously there's a recovery that is taking place, and it'll give a little bit more comfort level to the lenders to know that they're okay with being able to move forward lending money to that organization, that company.
Absolutely. Now, another thing I heard that is key is not only the cash flow, but post-transaction, looking at continuum of management, right? Yeah, here up till now, the business has been able to produce at these rates with these people, but after the transaction, how is that going to change? Are they going to be able to keep the growth? Are they going to grow it even more? Or are they going to make the company dip, right? So I think continuum of management, especially the key players in regards to a business, having them on board post-transaction eases, the banks, how they look at the transaction. Is that correct?
Yeah, I think management is always going to be a key role in what they're looking at, but also how did management cope with what was going on during the pandemic? And I think they'll also look at what was the trend in that particular industry, and how do they compare it to other um, similar companies in that industry. Were they up, were they down compared to many of the other companies in the same industry?
Right.
I think I think, yeah,
Yeah, Pete, go.
Valentino, I just want to chime in and say, yeah, I think if you're looking at making an acquisition, um, changing as little as possible initially when you come on board, I think is a good thing. Like you said, it's management continuity is really important. It depends on the structure. Sometimes there's an owner, and the owner does everything, and that's usually not a good thing. Because everything relies on the owner. He's doing sales, marketing. He's overseeing the manufacturing floor and so forth. If it's a smaller business, and if you're looking to acquire a business like that, you may be able to get it at a better valuation because there's a lot of risk there. But at the same time, there's a lot of risk there, right? If the owner doesn't stay on board, if he just hits the road and leaves you with the business, that's a concern. If there's a good management team in place, keeping them in place and maybe giving them incentives to continue to stay and help you grow the company, I think that's good. But everything that you mentioned makes sense, and what Brian talked about makes sense. So management continuity is really key. For kind of ensuring the success of the company going forward.
Perfect. Great to hear. Now let's dig a little deeper. This is what a lot of people are interested in. They want to understand, okay, so we have brokers, we have a lot of guys who are involved in various aspects of an M&A transaction, accounting, and so on. And they all have different ways of looking at a business, evaluating a business. So, for example, we got EBITDA, right? We got seller's discretionary earnings. We got all these models that include many add backs.
Right.
So I wanna position in the question where we could dig a little deeper regarding EBITDA. I understand it is simpler to evaluate with it, but I want to understand: can you use those add backs? And let me talk about what's EBITDA. EBITDA is earnings before interest, taxes, depreciation, amortization. Correct? Maybe that in some other things like owner salary, personal expenses. I want to know, if we're making an offer on EBITDA and it has all these add backs, can we use those add backs to finance the transaction? Can we use the cost of the taxes, the interest, the depreciation, the amortization? Let's say it's worth $500,000 there, and interest, taxes, depreciation, amortization. Can we use those $500,000 to cover back the loan, or is that removed? Is that an expense we cannot use?
When you're looking at cash flow and the ability to cover debt on the loan side, you definitely can add them back because they're a paper expense, right? So you want to be able to add it back to be able to show what the true ability is for that business to repay that debt, and it's extremely important. And it's mostly, those are things for tax purposes, to be able to lower the amount of taxes that you pay legitimately. But from a debt service coverage standpoint, you definitely want to add those back because they're not affecting cash.
Okay, so let's have an example here. Let's say we have a business we're looking to acquire, and this business, we're looking to do a cash flow based loan. So we're looking at non-SBA 7 years, 5% interest rate, around there. So EBITDA states that it's $1 million. And the offer from the broker is 4 times EBITDA is $4 million. But if we take a look at, digging a little deeper, what's the net? Let's say the net is only $400,000. And we're making our offer on $4 million. So we're looking to cover $4 million with $400,000 over 7 years with 5% interest rate. And the numbers aren't penciling out. Do we, you see a difference between EBITDA and net? So net is 400, EBITDA is 1 million. If we had 1 million cash flow, can we use the whole million from the EBITDA to cover the 4 million? Or do we have to use the 400,000 from the net to cover the $4 million loan?
My experience has always been that when you're looking at a loan and you're looking at the debt service coverage, you're including the add back. So you're going to add back depreciation, you're going to add back the interest, to be able to determine what's the true ability for that business to repay the loan.
So if there's $1 million EBITDA, we could use that $1 million cash flow to service the loan completely
Yes.
with the taxes, interest, depreciation, amortization.
You would be adding that back to determine what the business's ability is to repay.
Okay, and we could use that to finance the transaction, correct?
Correct.
Okay, great. So let's talk about seller finance. Let's move on to that portion. Now, I see there's a lot of people that are looking to incorporate seller finance with the transaction. Reason is, let me give you a couple reasons. One would be it eases on the loan as there's less smaller LTV, so less risk on the bank side. The other thing is if the seller doesn't want to take everything up front as they're hit with massive capital gain taxes, they could structure a portion of equity to be paid out over a series of years as a retirement plan. So any of those options or opportunities, I understand that when banks fund a transaction, their note comes primary. And so I'm going to give you what I know, and you correct me if I'm wrong. So let's say we're funding 60-40. We're funding, let's say, $600,000 from the bank and $400,000 in a seller note. So this $600,000, that is the primary loan. That is the primary note. That's the first that's going to get paid. Secondary comes the seller. That's why the banks don't care much about the seller finance, because their note gets paid first. Is that correct? Right?
Correct.
Okay.
Yeah.
Correct.
So there's no issue in regards to the amount of seller finance we could do, as long as we're able to service the cash flow, the debt from the bank, right?
There is. This is Pete. I'm going to let Brian talk about this, but there is a restriction on seller financing.
Yeah.
If it's SBA, and I'll let Brian get into that.
So typically when we're looking at an SBA transaction, two things happen with the seller portion. SBA only typically likes the seller to include 5% of the typical 10% that's required down. And some of the lenders require that to be on what they call standby throughout the life of the loan. In other words, the seller would not be able to get penny one paid back to them until that loan is paid off. And that's called the standby seller note. So you got two things to look at there. How much the seller can include as part of the down payment and hold behind the SBA loan. And then the second piece of that is whether or not the lender is going to require it to be on standby throughout the life of the loan.
Right. Okay, so if we're not going the SBA route, we could do a 60-40 without an issue, and having the seller note active, yes, which means the bank and the seller gets paid, right?
Correct.
Okay.
Yeah. In most cases, yes, some of the lenders might have their own policies, though. So
right.
You got to find out lender by lender, is there a limit to the amount that the seller can hold? Right,
correct. So let's talk about overfinance. A lot of people want to know about it. Understand it is standard to overfinance 10% in a transaction to cover professional fees, pay the directors. But what in the case that we have a surplus of cash flow? And let me give you an example. Let's say the business is producing $1.5 million in cash flow, and we're only financing $500,000 of it over 7 years. That's $3.5 million. So we got $1 million left in cash flow. And from that, let's say $300,000 is going in a seller note. So we actually have $700,000 clean that we could use. Could we pull out extra money from that up front to essentially build ourselves a capital pool? Would that be in the same acquisition loan, the primary loan, or would we have to do a secondary like bridge loan or another type of loan to pull out that money? Any thoughts on that?
My initial thought is that they would require a bridge loan after the fact, because in most cases during a purchase, they don't like you to be able to pull cash out of the business.
I see. So it'd have to be a secondary loan with whatever cash flows left, correct?
Correct.
Okay, great. Now, equity gaps. Very quickly, understand you have a network of lenders, network of contacts, which you use to finance transactions. Am I right?
That's correct. Yeah.
So I want to talk about one of the major things is, for people starting out, essentially your first deal, that 5 or 10% equity. That's an equity gap. Do you have any contacts that could assist in regards to funding that portion? Either investors, could a bridge loan be used, private equity?
What a lot of investors are doing today, Valentino, is looking at unsecured business funding options.
Unsecured to cover the minor portion?
Yes.
Oh,
Unsecured business funding can come from a brand new entity. You can set it up today, and you could potentially get up to $150,000 of unsecured business funding that you could then use towards the down payment. And
oh wow, that's new.
it's it's based primarily on your personal credit score. So there's three qualifiers:
Right.
680 or better credit, 30% or less utilization on your personal credit cards, and then minimum, actually no more than usually 5 new inquiries on your credit in the last 6 months.
Great. Let's touch a little more on that. Let's say the person does not have the credit that is required for to do that, but there's an equity partner that's willing to come in and basically guarantee on the loan. Could that be an option as well?
Yeah, somebody can step up to the plate in place of that business owner to use their credit, but the only time that it would affect them is if that business owner defaults on that business debt.
Right. So let me ask, the smartest thing would do to, if you have the cash flow after you get that minor equity to close the deal, pay it back as soon as possible so you don't have that liability.
That's correct. Absolutely.
Great. Is the limit up to $150,000, or are there any more ways to go up to, let's say, 250, 500,000, maybe secure lending per se, but with an equity partner?
Well, the other way that people do it is if you do have an equity partner that instead of putting the money into the business, they might set aside a CD to secure, say, a line of credit. A bank is willing typically to do 100% of that CD. And so the money is secure in the CD. Only in the event of the default would they come after it. So that's a way to secure a line of credit to be able to use for that down payment.
Right. Let's touch a little on investors. What do they look for apart from an internal rate of return? Is it mostly like it's not just the deal, but the overall vision, the overall plan?
Yeah, I mean, I think a lot of, if you talk about private equity, certainly the growth potential of the business, the industry it's in, but a lot of them look for what they call add-ons, right? There's two things that they look at: a platform business and an add-on. A platform business typically, for most of them, would have 2 to 3 million and above in EBITDA, and then an add-on, might be a small business with as little as $500,000 in EBITDA. And if someone in your audience is looking to acquire a business, certainly partner with a private equity firm. And if they're able to find businesses that meet the add-on criteria and are in the industries that these private equity firms are looking to kind of do roll-ups or add complementary businesses to a platform, they would absolutely entertain sponsoring and supporting an entrepreneur that has found this acquisition opportunity.
Sounds
so
great.
let's
touch a little deep real quick. One of the things is that people don't want to give up a large portion of equity of their company. Let's talk about that equity that is given out. Could that be at a subsidiary level? What I mean is just for that specific deal, not the main co. And if we have to give up equity in the main co, can there be a buyback clause in regards to that equity as we grow, buy it back?
Sure. There, I mean, you could definitely structure it that way. If the investor, it depends. If it's private equity, it might be a little bit tougher, but there could be a lot of individual investors who are looking for places to put their money, and if they can build a relationship with an entrepreneur, then they might be more willing to have a structure that's more amenable to the entrepreneur, and giving that person a bigger equity stake, maybe even having a buyback, giving them incentives. Hey, you grow the company to this level, and then we'll give you an opportunity to buy back, or actually give you additional equity in the firm if you're reaching certain milestones. So I think all of those things you just asked about are available. It just depends on the type of investor that you're working with.
Right. Essentially, what people don't want to fall into a trap of becoming a deal finder, where the private equity firm has the control and now they're essentially working from. It is usually the first transaction where the hurdle's at. After that,
Absolutely.
if they structure it well, now they have cash flow to put down on the later transactions. So I think a private investor, individual investor would be the best route, correct?
It would be. Yeah, in that case, absolutely. So in that case, the entrepreneur that has found the business and needs to partner with an investor, they want to make sure that they structure a deal where they're the majority owner, they're running the show, and they can call the shots. So I agree with you. And most private equity firms, they've got companies on the buy side. I mean, I work with a lot of them, and I'm out there finding companies for them too. But I'm also working with entrepreneurs who are looking to acquire businesses. And your suggestion is the right one. Is those individual high net worth individuals? Those are the ones that are better positioned to put together a deal structure that's more amenable to the entrepreneur.
Right. Now, let's talk about deal sizes. From what I've heard, investors want minimum 1.5 million EBITDA. Reason is they could get better returns, and there's more room in regards to cash flow. The smaller the deals, the harder it is to finance. Is that correct, or is that a myth?
Yeah. I mean, just in general, the amount of effort and due diligence that's needed for small deals typically is almost the same as larger deals. So the firms that want to put money to work, they want to do less deals and have them be bigger rather than more smaller deals. So there's no question. $1 million in EBITDA is like the magic number. Once you get to that point, then that business is going to have a lot more interest from private equity or strategics or other investors. And that's not to say that someone smaller. I work with lots of businesses that are doing maybe 500 to 800,000 in EBITDA. If it's a strategic business, if it's an area that fits with some of these firms, it could be a great add-on. But you threw out $1.5 million. That's a good number. When you start to get there, and $2 million, you're talking about a very attractive acquisition candidate.
Now, one guy told me, and it is not the money that gets you a deal, it's the deal that gets you a finance. Taking that into consideration, there's a lot of people who are scared of going after a larger deal as they don't have experience. But I see that if you could find a larger deal where the seller is willing to move in a structure and a price that is financeable, that makes sense, I see there's a lot more opportunities of going ahead with that one than just focusing on smaller deals and building up. Would you agree?
Yeah, I would agree with that. I mean, if an entrepreneur, someone on this call today, if they're listening and you're able to find a good business, a larger one, and build a relationship with the owner, and you can structure a deal with seller financing. A lot of these companies, they're family owned. It served the owner really, really well. It served him or her and their family, and they're not necessarily looking for absolute top dollar when they sell it. They'd actually prefer to have a really strong entrepreneur or buyer come in and maybe preserve the employees, preserve the legacy of the business, and that could be a really good structure. So if it is larger, one, $2-3 million in EBITDA, and maybe it fits the seller, the seller's criteria really well, where they don't need a huge lump sum up front. They're willing to do seller financing for a big chunk of it. That might give the entrepreneur a chance to acquire a bigger company, and they don't have to just focus on the smaller one. So it depends on the deal, depends on the owner. I would say look for family-owned businesses that have been around for a long time. Try to build a relationship with the owner and their family. Explain what you're looking for, and if you can build that relationship, you might just be able to negotiate a deal that makes sense.
Absolutely. I want to touch on roll-ups. I've heard about the roll-up model. A lot of people are talking about the roll-up model. How effective is it, and what are the, chances of you actually completing a roll-up and going public?
It's funny because just in the last month or two, Brian and I have had so many conversations with folks that are looking to do roll-ups, and I'd say in almost every case, when we say, "Okay, how many have you acquired so far?" They say, "Well, we're in the midst of doing our first one." So, so at least the ones that we've talked to, they haven't made a lot of progress. They haven't gotten a lot of traction. Is it a smart model? I'll give you an example. There is, we were working with a local veterinarian business, and there is a couple of companies that have done roll-ups in that, these fragmented mom and pop shops around the country. The issue with roll-ups or the opportunity is, you can typically acquire the small business at a lower multiple, maybe 2 to 5 times. And, you're buying businesses that might have 300,000 to $1 million in EBITDA. Now you roll them up, and now you build this network of these businesses, and now you've got 10, 15, 20 million in EBITDA. Now you might get a multiple of 7, 8, 9, or even more, depending on the industry. So in that case, it makes a lot of sense, right? So the smaller business will almost always have a lower multiple to EBITDA in valuation. You put them all together, and now you might be able to double or triple the multiple that you could get, from a larger entity, or if you're going to go public, and so forth.
Right. Let me expand a little into that. So, as you know, a lot of guys who are looking to get involved and do the roll-up model. They're looking to do a deal at a time. It's going to take them forever to get that completed.
Right.
What do you say if you could get 3, 4, 5 deals simultaneously? Wouldn't it be smarter? Would it be better?
Yeah, I mean, that's if you can kind of lock up smaller businesses, and, like you said, do 5 or 6 of them, lock them up. You may not even need to necessarily do the acquisitions of them, but maybe put a deal in place to say, look, we're doing a roll up. We can get X times. If we can put all these companies together, would you be interested in being part of this? Put them all together, kind of lock them up, have some sort of an agreement where they can't sell to anyone else. They're part of the roll-up that you're doing. And then you go out to a bigger player, so you might have a relationship with a buyer that says, we're acquiring, for example, home services. That's a big, you asked earlier of what's a hot market right now. Home services, recurring revenue, HVAC, electrical, plumbing. So if you went around and you found a bunch of plumbers in an area, that would they've got solid businesses, and they would agree that, yeah, we would be part of this roll up, and you promise them a certain multiple to their earnings. That's something that could be attractive if you can go out and say, I've got 10 of these plumbing companies. They represent this whole contiguous area of this state, and it's 30 million in revenue and 5 million in EBITDA. Then you have something there. And like I said, you may be able to structure it where you don't actually have to do the individual acquisitions. You can just be the guy that assembles them all together, locks them up, and then you shop it. It's one way to do it.
Let's dig a little deeper on that. What do you mean by locking them all up and then shopping it? Would you say like sell to another player, like be an intermediary?
Exactly. Yeah. So that's what's happening. Is private equity, just as an example, they want to buy these home services. I'm just using that as an example, but there's lots of them. It could be veterinarian, like I said earlier. There's lots of industries that can be rolled up. If it's highly fragmented, if it's recurring revenue, and both of those examples are, you could just do deals with the owner and say, look, your business, if you sold it on your own right now, is worth 3 times EBITDA. I'm going to put together 10 of them, and I'm going to get 7 times. And I'm going to give you 5 instead of the 3 that you get on your own. So, I mean, that's just one way to look at it. It might be a little tricky, but otherwise, like you said, you're just acquiring one at a time, and you've got to make sure that you can operate each of them once you take them over. You're going to operate them profitably, grow them, and go ahead and do multiple transactions. Like I said, all of the roll-up discussions that we've had, not all of them, but most of them, they've got great ideas on the roll-up, and they just haven't executed it yet. So
great. Let's talk about 2 more reasonable models. These are models myself and my partner Ansi are approaching. What would be essentially is the buy and build and the one-stop shop. Buy and build, there's 2 models, Model A and Model B. Let me start with the simpler one. So let's say we look to acquire a physician office, right? And this physician office has multiple empty rooms. So what we look to do post-transaction is take advantage of those rooms and bring in other physicians that work in conjunction with the service that is being offered there. So essentially we got multiple services under one roof. And the thing with physicians, and this was Ansi was speaking with one of his industry experts about this, is that when you bring in the physicians, essentially they're not paid on salary, they're paid on performance, and they bring in their own clients. So these clients are generating that revenue to cover them back. What do you think about that model?
Yeah, it's a fantastic model. I'll give you an example. I just worked with a seller and buyer of a chiropractic office. The buyer had experience in building another practice where they acquired a chiropractor that was really doing basic adjustments, maybe massage. And then they added all kinds of other services, physical therapy, weight training, beauty, cosmetic stuff. And they just blew that business up. So I helped this buyer acquire a chiropractic business, and he's doing exactly that. He's adding all of those other related medical services to the practice, and in just the 5 to 6 month period, the business is doing really, really well. So I think the model that you're talking about is fantastic. They bring in their own clients, they get paid based on what comes in, so you don't have to tack on salary. Now you have patients of different services that you can cross market to, right? So you have a much bigger customer base. You can offer them other services. Medical is a very hot area now, and it probably will continue to be. So I think the model that you and Ansi have is a very, very good one.
Okay, that's just Model A. Let's talk about Model B. There's this other
Okay.
one where, let's say we look to acquire a business that has more parts to it. Let's use a hospital, for example. Hospital has billing,
Uh-huh.
has insurance, has pharmaceutical supply, has the staffing, so on. So what we look to do, and see if you have any experience with this, is we'd acquire the hospital, and then what we look to do is acquire all the third parties, essentially everybody that is servicing to that hospital. So we create what we call a self-sustained ecosystem where we're in control of the environment, not only the business itself, but who's serving to that business, right? The staffing, the billing, the pharmaceuticals, and we de-risk it because we're in control of the third parties now. Any insights on that?
Mm-hmm. I don't know, Brian. Do you want to chime in a little bit on that, maybe?
I think it, it's it depends on what kind of loan you're going for too. So you got to look at how much space is the owner of that particular property taking up at that point, right? If they're occupying more than 51%, it's not going to have an effect on anything from the debt side. But if the other people that are utilizing the space will occupy more than 51%, it may take them out of SBA compatibility and compliance. So it just depends on how are they looking to finance it from a debt standpoint. You got to be careful.
Right. Funding aside, let's talk a little more, Pete, about the structure of it, right? Where we're essentially buying out the third party, supplying it to ourselves. So we're creating this self-sustained ecosystem. Would that exponentially grow the business because we're in more control of things per se?
Yeah, I think so. And what you said is one-stop shop. I think if you can do that, that makes sense. I mean, what I would recommend is certainly having some expertise in those areas, and maybe your team that's going to be involved there, has expertise in running all of the different vendors and suppliers and so forth. But that's vertically integrated. I think that makes sense.
Right.
That would be a big acquisition if you're looking at acquiring a hospital and all the ancillary businesses tied to it. But that could work.
But if you can pull something like that off, what type of exit multiples we're looking at? Are they on the larger side?
I don't know, to be honest with you. I don't have experience necessarily in the multiples of what hospitals are at. I mean, I could certainly do research if anybody on the call is interested in that.
What I mean is not just hospitals, but any business that has many moving parts. We could acquire the ancillary and complementary, supplementary businesses where we're in control of the environment.
The multiple would be higher, 100%. Yeah.
Okay, great.
It's the same. Yeah, it's the same as if you're doing a roll up, right? So the multiple on one entity is going to be much less than when you put 10 entities together. So if you end up owning the hospital and then all of the suppliers and providers there, and you own that entire entity, then the multiple of that would certainly be a lot higher than each individual piece.
Right. Now, in regards to roll-ups, I've heard many guys, even a roll-up expert, tell me the thing about his execution, it's the synergism that it has between each other, right? You can't just add random pieces together and make it work. We got this model, which is the one-stop shop, essentially. But let me paint it to you in a different picture. Let's say I'm looking to acquire physician offices in Los Angeles, right? So let's say let's say there's 10 different type of physician offices for 10 different body parts. Keep it simple.
Okay.
And let's say there's 1,000 physician offices in Los Angeles. The thing with physician office is usually, the neighborhood doctor, they see the people around themselves. Now, let's say we look to acquire 50 of those physician offices. We look to acquire 5 in every subsidiary, 5 of each from the 10, make 50. What we look to do then is basically implement a standard of operation. Let's say we're we're building a brand per se, where
Right.
there's a standard of operation. The owner, if they want to stay after a transaction, they're essentially just same thing, business as usual, working in, on the patients, receiving salary. But I say we're more in control due to now we have a larger capital pool as we have multiple acquisitions. We're essentially a force within it. We're like consolidating it because there's so many little guys, but now we're building a brand with a standard of operation where anybody walks into one of our offices, they know they're all receiving the same level of care in every single one of them, which is great, right? So it's building more of a trust, more of a customer retention and customer expansion, where if they need another service, well, they'll go to us. Any thoughts about that?
Right. Yeah. So I think in that case, you can implement similar software systems. You might even be able to have a centralized call center that can handle appointments for many different offices, right? There's a lot of economies of scale and maybe costs that you can ultimately take out of the individual businesses that would go to the bottom line of the combined entity. So, if you do that, it's kind of like, a franchise like McDonald's, when, usually you go to any McDonald's and you get exactly what you expect. It's the same in each. I think that's what you're talking about. The experience is the same. The forms I have to fill out is the same. Instead of everyone having their own individual website, you have one platform
and
that
multiple
can service
services.
all of those.
Yes.
Exactly.
Yes.
Yeah.
It builds that customer trust, huh? Perfect.
Yeah.
Now let's talk a little about refinancing on a transaction. What do we look for to refinance on it? Is it like we built up the business, now we have more cash flow, we want to pull something out?
I'll let Brian talk about that.
Sure.
Yeah, so you definitely always want to look at the cash flow. You want to also see, you're going to need to get a business valuation done at that point and see what's the actual value versus what did you borrow against the business. So again, we're talking about two different things. If we're just looking at the value of the business, there's no real estate involved, then you definitely would need to get a business valuation, much like you would need to get an appraisal done on a piece of real estate. Once the lender knows what the true value is of that business, then they could determine what LTV they want to go up to and see if there's excess equity available in the business to be able to borrow.
Right. Sounds great. Okay, I think those are all my questions. Let me move on to Ansi. You got any questions?
Yeah, just real quick, Pete. At what point in what scenario would we need a PPM from investors? And if we're going after only accredited investors, do we need a PPM?
I think you're going to need that early on, no? Right. So you're going to need to describe what it is they're going to get for their money. So you're going to want to have that established right up front.
And accredited investors, would they need a PPM as well?
I'm not sure exactly what's needed for them. I think having it at least describes, the value of the business, the structure of the deal. So whether it's, accredited or larger entity, I think that's something that you definitely want to put together up front so that someone knows exactly what they're getting. Is it a preferred investment? Is it common stock? I think that's important to have in place early on.
Okay, so a lot of investors don't like receiving K1. Now, in our scenario, for guys like us buying businesses, what kind of structure, I'm not sure in your experience, do you see a lot more that's being used when guys are starting startups like this? More so investment firms like ours. Is it like a holdings company? Would that make more sense? Or would a C Corp make more sense? Or would that ultimately depend on if you're actually raising funds or not? Yeah,
I think it would just depend. I'm not necessarily an expert on the structure, but that, maybe, are you guys have good legal counsel, that a good transaction firm that handles that. That might be better to speak to them, but it's going to depend. It's going to depend mostly on what type of deal it is. How you have to structure it, what the investors are looking for. They might say this is what I typically invest in. This type of structure. I think it depends. I'm not necessarily an expert in that.
All right, perfect. Appreciate it.
I think we're good. Yeah. So
yeah, that was all the questions I had.
I opened it up for Q&A. If anybody has any questions, been about a couple minutes, nobody's asked. I think we touched on all the topics. But Pete, Brian, I appreciate your time. These are the type of conversations that are really changing the M&A industry, especially for the new guys. They're hearing so much from all these other people, too many opinions going around, and no real facts from experts, right? So I really appreciate it.
We also, and no, thank you for inviting us. I mean, if anyone wanted to contact us, we have a lot of info we can just email out to them. One of the things that we do here in Florida is we work with a couple of organizations called GrowFL and Florida Makes, and those organizations are strictly there to help companies grow, and they work with a lot of entrepreneurs. So we give out lots of info, with no expectation, and we just want to help people succeed. So I'm happy to speak to anyone and help anyone in your audience with any questions they might have later.
Definitely appreciate that. Yeah. So as for your contact, we'll be giving it out to those who are serious. Other than that, great. Like I said, I appreciate it. Thank you very much, guys.
Thank you very much.
Thank you very much. Take care. Bye.
Bye-bye.
Bye-bye.
Number one M&A group in the world. Come on, who's touching on all these bases? Nobody else. We're the only ones asking true questions. We're the only ones providing true insights. And hey, guys, stay tuned.